on the website and how you're gonna get your account ready so you can compete in the stock market competition. And one last thing, we might just give out a final prize at the end of the competition next April. So I think you should really compete in this competition. So we're gonna drop the video in the group chats very soon. And yeah, pretty much that's it. Looking forward to it. Yeah, you can win a prize. Okay, so moving right along, we actually have a huge guest speaker today. His name is Mcdonald. And I just want to introduce you a little bit to Mcdonald right here. So,
well, Malik, remember that we have 5 minutes with Jason first, so let's just go through that.
My bad. Yeah, sorry, I'm so excited. I didn't even realize. Jason, you can go ahead and bring us the news update.
All right, cool. Hey guys, welcome to another week. So this update isn't just stuff from this week, it's from the summer that we, enjoyed. So can you guys see my screen okay? You should be able to see it in full now.
Yes, we're seeing it, Jason.
Full screen. Cool. All right. So First thing, we had financial results, quarterly reports, annual reports coming out for so many companies. Here are the highlights from some of the interesting ones. So Barita had amazing statistics going on, and this is looking at when they had their APO at 80 Jamaican dollars per share. So they have good stats. I'm not going to sit and go through all of them because you can look at them and we have a lot to get through. So we're moving on. We're looking at how that price went up since the middle of this month. That's crazy. We see a little dip, but like if you bought Barita earlier and you still have Barita now, then you'd have made a lot of money on it. NCB, they had a bond offering, and we know that they used the bond money to fund their projects. Now, these are the details. It was for 3 years for 6%. And yeah, they had some interesting news about that. I think Matthew had told me, you had told me something about them either coming short or like some weird stuff on their financial statements.
There's an article that just really said that I'm not sure how much money they initially set out to raise, but they cut it short at 15 billion, I think.
Yeah, it was just some weird stuff going on, but we'll see how that turns out. Signos had some really cool changes to their foreign exchange part of their reports. So at 2020, most of these numbers look fairly similar until you look at the fair value gain and the net foreign exchange gain and loss. So we see that the losses are in brackets, and that number in brackets, which is how much they lost, was way lower in 2021. So primarily due to that, they were able to raise net profit attributable to shareholders by over 150%. Signos is a company to watch, and seed stocks there. Kind of volatile, not really huge jumps, but since the price is so low, you know that if you bought it at 15 and you bought a lot at 15 and it goes up to 16, you still would have made a lot of money. Carb Cement, wonderful company that all of us love. They set up a special board to look at their dividend policy because they're making so much money, most likely. Let's look at that. So $90, it was a little over. And if you, this is in July, and this is near 120 right now. That's just amazing. Like Carb Cement was our case study so many times last year, and it keeps on doing really well. Wigton Wind Farms, they had some really similar numbers again going through until you look at their current liabilities, and they dropped a lot over the past year on year. I don't know what's up with that, but it's something that we wanted to point out to you guys, especially if you're looking into holding the company or if you already bought some shares. Siboney, Malik, you want to tell us about this?
To be honest, I haven't really been following Siboney since their last stint, like back in spring, but I think Victoria might have been keeping up a little. I'm not sure. Is that true, Victoria?
I've been watching it, but to be honest, I have no idea what's the explanation for why Siboney is going up and down that way. Even just this week, 2 days out of the week, they halted twice in a row. And guys, if you don't know what halt means it went up 15% and the circuit breaker tripped in. So I don't know what is really causing it. It just seems to happen in spurts. And then, of course, it drops back down very sharp. So it's a mystery.
So what actually happened was that on, I think sometime last week, towards the end of the week, their audited financial statements came out. And in the statement, in the auditor's report, they've essentially said that their parent company, which is FinTech, they're essentially, giving them $5 million to keep the company alive. And then after that, we got a notice that came out that said that some directors are retiring. They're sort of restructuring in a sense, moving the office to the Ministry of Finance. And, FinTech is a government agency that's trying to sell the company. So that's pretty much what's causing the run up in price now.
Thanks for that, Matthew. It's just been crazy. Like, Siboney has not been following much logic for a long time, and then it's just been so volatile. So again, the story keeps on unfolding as it has been since 2021. Some more news about Jamaica, a little less about stocks, but just the general environment for you to understand. So Standard & Poor's affirmed Jamaica's B+ long-term and B short-term credit ratings and moved it from negative to stable. So that's pretty good for us. We're making some strides despite everything we see going around us. For more news like this, guys, you can check out our Instagram page. So YIC_UEMONO. If you're not following them, you need to be following them now. So you see where it's highlighted in red over here. You can get weekly news stories like the ones we're talking about now. Of course, we're not going to be able to fit everything into this short time. So definitely check that out for other updates from the club at YIC_UEMONO. If you're not following and you're here, you need to be following now. Here's a pick to keep you guys going. What happened earlier this week? I didn't actually check what happened to the stock prices of these companies involved, but yeah, we know that almost all of Latin America was going crazy because they live on WhatsApp, live on Instagram, so many businesses, and just it was wild. More news just about the general environment. CDMA, so that's the Caribbean Disaster and Emergency Management Agency, now accepts blockchain to support its climate mitigation efforts, which is pretty cool. We're supposed to be working on some more info about blockchain, not necessarily this meeting, but in the future, so you guys can stay tuned for that. This was from way earlier. This is from mid-August. Cuba dips toe into market economy with legalization of small businesses. There were lots of demonstrations over people starving and being without medicine, and the government actually gave in a bit. Persons who are still there tell me that the businesses people are allowed to have still don't make any money because of, other circumstances, but step in the right direction. Inflation has been crazy, right? With all this money printing that the coronavirus has been causing persons to justify. So that's why we invest to run out of it. And this is not just a Jamaica, not just an America, not just a UK issue. This is happening all around the world. Now, the hurricane that hit Louisiana recently, I threw this in here because investing is about being long-term. And inflation, printing money now to rise inflation is a very short-term strategy. I'm not criticizing, they shouldn't do it. I'm just saying it's a short-term strategy. The Netherlands has a long-term strategy for sea defenses. Louisiana doesn't. And the few that they put into place aren't really suitable, and everybody knows that. Why is it still there? Because of the culture. And guys, in Jamaica, we tend to have a very short-term culture as well. So this is just to illustrate, it's not only about us. We shape our environment. We need to move on, but we have a little time for thoughts, questions, or comments. Anything else you guys saw or you want to add? Going once, going twice, or do we invite our lovely... Okay,
thanks, Jason. It was a great presentation, and you guys should really keep up with the market and the news that's going on, because if you've been watching the market, it's pretty crazy and interesting these days. Like, a lot of stuff are going on, a lot of new things coming out, a lot of things to look forward to, and therefore opportunities to invest in. So guys, make sure you stay tuned and follow us on YIC_Uimona on Instagram. So yes, thank you, Jason.
Okay, let me drop the link quickly for signing up for the stock market game. I just dropped it in the comment section. With that being done, I'll be reading. Sorry, external noise. Okay, so we have a huge guest speaker today. We're all interested in coming today to present and everything. So let me move on to that. So Mcdonald is a Christian entrepreneur, investor, technology enthusiast. Sorry, guys, something just popped up on my screen by accident. Yeah, let me restart. Mcdonald is a Christian entrepreneur, investor, technology enthusiast, and content creator. He's the co-founder for the LearnGrowInvest community, which focuses on financial education and literacy. LearnGrowInvest was founded in 2017 by Jermaine and his wife, Renee. This community focuses on creating content and providing individuals with the resources needed to become better stewards of their finances. You can connect with Jermaine and LearnGrowInvest on all major social media platforms. Search LearnGrowInvest on YouTube, Instagram, Twitter, LinkedIn, Facebook, and TikTok. With that being said, guys, please help me welcome Jermaine Mcdonald of LearnGrowInvest. Jermaine?
Hi, everyone. Hopefully everyone is doing well.
Welcome, Jermaine.
Thank you. Thank you. I'm here very impressed with just what I've seen so far in terms of that market update. I'm actually very, very interested to see how you guys would discuss that information, but we can talk about that after. So today, what I'm going to try and do is walk you through how to select the best investments for yourself. Now, investing by itself is a journey. It's not something that you're gonna figure out all in one go. So it's everything that I'll share here. It is for you to really process it, see how it would apply to you. If you already know some of it, that's okay. I'm hoping that there'll be at least some sections that may be impactful for you. So let me know if you're able to see my screen.
Yeah, we're seeing it.
Okay, perfect. All right, so this first slide was kind of shared already in the intro, but I thought I'll just kind of say just a little bit more about what we do as LearnGrowInvest. Now, we started this community for persons to learn more about investing, budgeting, personal finance, and all forms of investing. So it's not really stocks. I mean, though that's what our community likes to talk about the most, but it's all forms of investing. So we have persons in our community whose focus is real estate. That's all they're interested in. There are persons who are interested in cryptocurrency. That's all they speak about. And so each person can take what matters most for them. For us, we are Bible-based. I am Christian, as mentioned before. And so, for us, our foundation is Deuteronomy 8:18. And we credit all of our success to, our Lord and Savior. So we definitely recommend that you connect with us on all platforms. We actually have a Telegram group as well. So if you're interested, feel free. I think Malik should be able to share that link with everyone. Right, so I have to say this, I have to put this little disclaimer here because as a community that speaks about investing so much, we have to be careful. There are certain questions that we can't answer directly, but we can guide you through. And that's because there are rules, governing this industry. So the things that I'll share here, I have to say that it's for educational purposes, and we will be able to get into detail with some things, but what I cannot say is specifically by this or that. I'm not allowed to do that, but we can definitely have a discussion in terms of, you know, scenarios, what options could work, and that kind of thing. So just have to say that there. And in terms of our agenda, we're gonna cover some key things. So I'm gonna introduce you to investing, though I don't think you guys need it, but we're gonna talk about what investing is, so it will frame the rest of what I'll say. I'll introduce the concept of an investor profile. And this is something that not a lot of investors think about. You know, some of us just kind of assume that we all approach it in the same way, but that's not true. Our tolerance for risk plays a big part in how we invest, and in finding the right investment for you, you have to consider your tolerance and capacity for risk. So I'll speak about that. The next thing that you want to do is know how to set financial goals and make them smart. So a lot of persons are not sure what goals they should set for investing, like how much should I invest? What should be my target? So I'm going to speak about that and give you 3 examples. Next, we're going to speak about asset classes and allocation. So you want to know what the different asset classes are, and you want to consider which ones are right for you and how much of those assets you should consider for your portfolio. We're going to talk a little bit about balancing risk and reward. That's what investing is. There is always risk. If anyone says to you there's a risk-free investment, I'd be very skeptical about that. And the last thing that we'll speak about is how to pick your own stocks. Now, based on what you guys have shared in terms of how you've been tracking the market, let's see what I can add there in terms of value. All right. So let's jump right into it. Oh, and I'll say that I'll take questions at the end, so that way I can get through the presentation first, and then we'll just take any questions. So you can type them in the chat or write them down, and we'll take them all at the end. So my definition for investing is spending money or allocating resources with the expectation of income or profit. And what that means is that we can invest in a lot of things, not just stocks, not just real estate, not just cryptocurrencies, but we can invest in our education. We can invest in our jobs. We can invest in a new skill or hobby. So it's really, you know, where are we spending our money or resources? That determines the success of the investment. So when somebody comes to me and says, Jermaine, I'd like to get started with investing, I'll ask them 3 things. I'll ask them what their tolerance for risk is. I'll ask them what vehicles of investment they're interested in. And then I'll ask them how long they're planning to stay invested for. So your risk profile, as I said before, is your willingness and ability to take risk. It varies per person, but this is what determines which assets you should invest in. Then we're going to talk about an asset allocation strategy. You know, should you invest in stocks, bonds, unit trusts, real estate, cryptocurrencies? That's all dependent on your risk profile. And then, as I said before, your time horizon is how long you expect to have that investment for. So for some of us, it's 3 months. For some, it could be 6 months, 5 years, 20 years. It varies, or it could just be an endless, you know, meeting those short-term goals and then staying invested for the longer-term ones. Right. So the very first step, as I said, is understanding your risk profile. So I'm going to take you through just about 8 questions that I typically will share with persons. Now, this is a part of a more expansive set of questions that you're likely to be asked by a broker if you should go in for an investment account. But these are some questions to think about, and they'll help you try to determine what your risk profile is, right? So I'm going to share the questions. I'm not going to complete the quiz here, but I'll share the link in the chat, and you can go ahead and complete it on your own time. So the first question that you're likely to see on an assessment like this is what sort of investor are you, right? So it's asking you, are you willing to accept a small amount of risk for capital growth? Are you instead looking for moderate risk for long-term growth? And these questions are really geared to understand what your what your mindset is. Some persons invest because simply they want to beat inflation. Others invest, because they want to grow their capital. And then there are others who invest for returns, that for income. So that may be dividends or some other form of income. All right, so that's the first thing that you want to think about. The next is what statement describes your investment objective, right? So for me, for example, I'm investing for high capital appreciation and income growth. So the type of investments that favor that may be stocks, because stocks, though volatile, they provide high capital appreciation. And if I'm invested in the right companies, that may be opportunities for dividends, right? So it's, as I said, it could vary per person, but you really want to go through this to determine what your objective is. So question 2 is extremely important. I think about that carefully, determine which one sounds most like you, and then that's the one that you choose there. The next one is asking how long you plan to be, how long you expect to achieve your investment objective. So for some, it could be, as I said, more than 10 years, 3 to 5 years, or it could be less, right? It could be 3 months, it could be 6 months. It really depends. The next one is speaking about your portfolio if it suffers a loss. Now, we saw with COVID where the market had a great sell down sometime in March, and a lot of persons got very, very nervous during that time, right? And I would say a lot of persons who were probably invested in stocks who sold early probably never understood what comes with investing in the stock market, right? So if you lose 25% of your portfolio and you'd consider selling, then maybe stocks aren't the right, things for you to be invested in, because as you guys saw, when I shared your review, stocks can be very, very volatile. So you may be down 25% today and up the same amount tomorrow. So, I mean, that's just something for you to think about. The next one is, asking about your attitude towards risk. Is risk, something that you avoid? Is it something that you want to take on some of it, but you want to minimize it? Is it that you're willing to take a little risk to gain some return? Is it that you want to embrace all forms of risk, right? Because there are persons like that. The riskier, the better. The riskier, the more exciting. And there's nothing wrong with that, right? Don't be afraid to take on risk. But I'll speak about later that balance, right? Because if, depending on the position that you're in, you can afford to take risk. The younger you are, maybe if you're single, you don't have children, your income is consistent. Those things may favor you taking on more risk. But as you get older, as you have more dependence or responsibility, or your income may be at a certain level, it may cause you not to look at risk in the same way. There's no right or wrong. It's just whatever works for you. All right. The next one is asking a question similar to the one that was asked before. So I'll just, skip that. And the last 2 questions is asking, how much income do you expect to have available for investing over the next 3 years, right? And that's important. So is your income going to be consistent? Will you have more cash? Will you have less cash? Those things factor in the type of things that you invest in. So one of the things we say to persons who are investing is to build an emergency fund. And we're actually talking about that in our Telegram group this morning. One of the things an emergency fund does, it allows you the flexibility to leave your investments for longer. So if you don't have money saved and you have an emergency, you'll have to sell your stocks, for example, to be able to get cash to, do things that you may need to do. And the last one is asking, how long would you invest the majority of your money before you begin to withdraw that money from your investment account, assuming that you already have savings to meet short-term cash flow or emergencies, right? And again, it's just something for you to think about. Typically, we recommend that the longer you can stay invested, the better. The longer you can leave the money in your investment account, the better. That doesn't mean that you don't take profits, but if you take profits, your plan should be to reinvest. You want to separate those investment funds because the longer your money stays invested, the greater it will be, or the greater it will grow, assuming that you're, of course, invested in the right things. All right. So after you take that short questionnaire, it will tell you one of three things, right? These are the risk profiles that it's likely to tell you about. And this is a very simplistic example. I don't want you to think these are the only ones. And I hope nobody is offended by the animals that are used, right? So there's nothing wrong with being conservative. That's okay. You just need to focus like on blue chip stocks or fixed income, money market vehicles or cash, right? If you're willing to take some risk, but you want to have a more balanced approach, then you're a moderate investor. Then you may focus on like dividend stocks with some bonds, right? It really depends on you. And aggressive, like I am. So my risk profile is moderately aggressive. So because I am married, because I have a mortgage and other things to consider, I can't go full on aggressive. 5 years ago, 10 years ago, maybe, but not now. So moderately aggressive is me. So there are some vehicles of investment for me that don't fluctuate or vary in terms of volatility. And I don't get much growth, but it means that they're there, and I know that if I need that money, it's there. While there are certain aspects of my portfolio that are high risk, and it's a percentage that I'm comfortable with. So if I lose all of that money tomorrow, I'm still shielded from a great loss, right? And we'll talk about that when we get to asset allocation. But you should know your risk profile. It should guide your investment decisions. And this is something that, for example, a financial advisor should help you with. This is one of the things you should talk about. You should say, well, I'm an aggressive investor. I'm interested in growth. I'm interested in high returns. What options do you have for me? And then you should be guided accordingly. All right. So I was saying this before that for each person is different. So if you notice, there are three key things here: risk capacity, risk willingness, and risk required. So if you think about risk willingness, that's really our desire to take on a certain level of risk. So as I said, that varies per person, right? So my risk willingness is different from Malik's, is different from Jason, it's different from Victoria. There's no right or wrong. It's just what you're inclined to. Risk capacity, though, may definitely vary as well. So it's based on your capital. So if I have $10,000 and Malik has 2 million, his capacity for risk would be greater than mine. So he can take a certain type of risk that I couldn't. But probably the most important thing here is our goals, right? So the goal that is set should really be what determines the risk that you take. So for example, if my goal is to pay for, let's think of something important. Let's say that I want to pay for surgery in 6 months, and that surgery is $2 million, then I'm going to have to be extremely aggressive in getting to that $2 million because of the goal that has been set, right? So that's really how you want to think about it and factor these in terms of your decisions. All right, so the next thing that we're going to talk about is your time horizon. So this is very, very important. We'll talk about setting goals next, but I'd want you to write down some goals, right? Write down, you want to buy a car, you want to buy a house, you want to buy a watch, you want to go on vacation, you want to buy a PS5, you want to, like, whatever the goal is, it's fine. Write down the goals that matter, and then we're gonna see how we can turn them into SMART goals next. But this speaks to your time horizon. So based on the goal, you need to determine, based on the type of goal, how long you need to wait. Now, as I said before, the longer you're invested, the better. I'm going to speak about compound interest as well. And you'll see that the longer you're invested at a certain compound interest rate, that you'll be able to grow your capital faster. But it all starts with this slide right here. What are those goals? So if you don't have goals, and you won't know what you're investing for, and you won't know you won't know what to buy and when to buy, and you won't know when to sell. All right. Well, we're going to speak about compound interest for a little bit now. This is one of those things that very few people understand. Now, so the reason why, for example, you'll hear persons say, stay away from debt, stay away from high interest debt. It's really because of a factor called like compound interest, right? So simple interest, for example, would be, I borrow 1,000 from you, you charge me 10%, I'll pay you back $1,100. That's simple. Compound interest now could be, you charge me 10% every month or 10% every 3 months. So what that means is that it's not as simple, but that interest can grow depending on how long I take to pay back the loan, depending on the amount I'm paying monthly. So if we apply that to investing, if we get a certain amount of interest on our money from our investments, and that stays in the market long, it compounds at a certain rate per year, then we can grow our capital extremely fast, right? So I'm going to show you a formula. Well, actually remove the formula because I didn't know how persons feel about math. So I didn't want to scare anyone, but the compound interest formula shows you it factors in your principal, rate of interest, how long you're going to be invested for, and it shows you how fast your money can grow over time. Now, this is a very simple example. So I have $10,000 is my initial deposit, and I'm contributing $1,000 per year for 10 years. Now, that doesn't really sound like a lot of money. After 10 years, I'm going to have $20,000, right? It's not very attractive, but I'm not getting any interest on that. So the interest, as you see at the right, is 0%. Next, I'm going to apply just a 5% rate of return per year. And that green section that you're seeing is the interest, right? So just at 5%, I went from $20,000 in 10 years to 29,000. So almost 50% on my money in 10 years at just a rate of return of 5% per year, but that's compounded, right? The money has not been taken out. The next thing that we're going to do now is look at that same amount. So same initial deposit, same contribution per year, but a rate of return of 10%. So if we were getting 10% return from the stock market every year and we leave that money there, after 10 years, we would have gotten over 100% on our money, right? And that's the power of compound interest, right? So same example, we're gonna take it a step further. $10,000 starting, $10,000 added per year, 0%. We just have 110,000. Our money has not grown, and we know with inflation, this is really less than 110, right? One step further, 5% rate of return. I went from 110,000 to 148,000. And the last one, 10%, I went from 110 to 201,000. So that's really the benefit of being invested in vehicles like the stock market, that ability to compound your money for it to grow faster. And it really, that's when you hear persons say your money is working for you, this is what they mean, right? So hopefully that makes sense. Next, we're going to look at financial goals. Now, every goal to me has some financial component. It may be zero, but there's still some financial component, right? So every goal can be brought to a smart financial goal, right? So it's really a target that we aim for when managing our money. It can involve saving, spending, budgeting, multiple income streams, investing, and more, right? The most important thing, though, is that they should be smart. So in terms of SMART goals, I'm going to explain what SMART means next, but I'm assuming that most of you know it already. So the first step in setting SMART goals is that you're going to think about the goal, write it down. Then I'm going to show you how to make it SMART. Next, you want to determine how you're going to achieve that goal. So you can either save the money. So if I wanted to save $10,000 to buy a new phone in 6 months, and my disposable income is $2,000 per month, I can save because I know in 6 months I'll have $12,000. If though the phone I wanted to buy was $50,000 and I have the same disposable income and the timeline was 6 months, then I know I'd need to invest because there's no way for me to bridge that gap with savings alone. And finally, I do have the option to borrow. Now, personally, I'm not a fan of borrowing except for things that are really out of my reach, like a mortgage, maybe a car, depending on the situation, maybe to start a business, etc. But I'm not going to borrow money certainly to buy a phone. That would make sense, right? And so we want to choose the right asset class based on that goal that we have set and based on our capacity or our ability to get to that goal on our own. The next thing that we want to do is automate, right? So when we've set that goal, we want to say, all right, we're going to send $5,000, $10,000 to our investment account each month. We want to determine which stocks we're going to be invested in or which asset we're going to be investing in. And we want to automate. And the reason why we automate is that, I mean, from personal experience, if I say I'm going to send $5,000 from my salary to my investment account, and maybe I want to eat a really nice burger this month because I'm just feeling like it, or maybe I want to, go and watch a movie, or maybe I want to do something that's outside of my planned expenditure. The more I spend in that way, the less I have to invest, right? So I want to automate so that it's not left up to me. And the last thing we want to do is have a plan B, plan C, and a plan D. Or plan A may not work. I may plan to save $2,000 per month, and then it turns out that, in month 3, I need to help someone. I need to, buy something from a car. I need to replace something. It could be anything that comes up. So it's good to have a plan B, C, or D because plan A might not work. All right, hopefully that makes sense. So we're going to look at 3 goals, and these are goals that I set for myself in the past. So in terms of SMART, for those who are unaware, SMART means specific, measurable, attainable, realistic, and time-bound, right? So the goal that we're going to break down is the first goal, which is goal to pay for a vacation. Now, my budget for a vacation is $150,000. I would have researched some nice hotels, saw the one with the nice restaurant, nice pool, nice view. And so I said, okay, my budget is $150,000. My disposable income is $20,000. That's the amount that I have left after my salary each month. And so I'm going to set out a plan to save and get to that budget, right? So that's what we're going to break down next into a SMART goal. So in terms of specific, I can say I want to save $150,000 in 6 months. Next, I'm going to say it's measurable because we have an amount. It's $150,000. So I didn't say I want to pay for a vacation, right? I've made it very clear. Next, I'm able to assess its attainability because I'm saying it's 20,000. So that gap, 20,000 times 6 is 120. That leaves 30,000. To me, that's a reasonable gap. So it's considered attainable based on my skill level to invest. I'm sure I can make $30,000 in 6 months. Next, is it realistic? Yes, I can comfortably save and then bridge the gap. Is it time bound? Yes, I've said it's 6 months. So of course, my plan B here could be, well, if I have to use the money for something else, maybe I want to set a more aggressive target than 30,000 profit. So I could say maybe I aim for 60,000 just in case I don't have the amount of money I need. And it could also be that in 6 months' time, that budget I have for the hotel is more because maybe US rates have gone up and the hotel is charging me 180 instead of 150, right? So that's what the plan B, C, and D mean. All right, so really, as we get into the next section, you really want to have an appreciation for risk. Do not be afraid of risk. It is something that we all have to contend with. We deal with risk in simple things such as determining how many locks we should have on our door, right? So if you have one lock, then you've really only mitigated that risk by a certain percentage. But the more locks is, the greater the mitigation against risk. But there's a certain tolerance or a certain acceptance for risk that we all need to take, right? So there's risk all around, right? All right, so we're going to talk about asset classes for a second. So we know our risk profile. We know the goals that we have. We know the time horizon. Now, for me, and that same example that I mentioned, I'm looking to raise, let's say, somewhere between 30 to 60,000 over 6 months. I really want to think about now which is the best asset class to invest in to get to that goal. Now, you guys mentioned the NCB bond earlier. I may look at that bond and say, okay, what's the interest rate? Okay, based on the amount that I invest, how much can I expect to get back in payments per month? Will that help me get to my goal? I'm going to determine no based on the amount that I'm starting out with. I'm starting out with 20,000 per month, and I'm getting that amount per month. So it's not like I have 120,000 upfront to invest. It's really 20 per month. So bonds in this case won't work for me. Will cash work? No, because I know that if I just leave my money in cash, I'm not going to get to that goal. Can real estate work? Well, no, because it takes me 6 months to buy a house. So I'm not going to be able to sell it, to buy it, make a profit and sell it in 6 months, not in Jamaica, right? So then my option for this scenario that I've created is equities. Now, depending on your goal, you may look at these different options, and there are more, but I thought I'd just cover these as a starting point. Now, if my goal is to buy a home in 5 years, or my goal is to save and invest for retirement, then real estate might work, right? I may say, well, let me take the trade-off of investing in a mortgage versus paying rent, because at least with a mortgage, eventually I'll own that asset. Whereas rent, I'm not getting anything in return. I mean, that's arguable, of course. Or I may choose, so depending on the time horizon, I may choose different asset classes to meet that time and my personal tolerance for risk. So in this case, I'm choosing stocks. I know it well enough. I've made some money before, so I'm fairly confident that I can choose stocks and get to my goal in 6 months. So in terms of something that you need to understand in terms of how to invest, you have well, there are two terms that I want to share with you. One is the idea of diversification, and this is something that speaks about lowering your risk by spreading out your funds in different investments. So it's a concept of not putting all your eggs in one basket. So as you see from the image, 3 different baskets and your eggs are spread out, right? So eggs in this case is your capital. So it reduces the volatility that you'll experience, because if we go back to the previous one, let's say that we were all invested in these vehicles. Last year, when COVID hit, would have seen stocks experience a sell-off. But if we had property, that value would have been maintained. If we had cash, at least in the short term, that value would have been maintained. If we had a bond, then that agreed payment would have been maintained. So we would have been protected in terms of that volatility if we were invested in the different asset classes. And that's really what diversification is about. You're spreading that risk Now, there are some persons who say, I only want to be invested in stocks. I don't mind that volatility. That's up to you. You can also consider diversification within a particular asset class. So I could say, for example, I'm only invested in stocks, but I'm going to be diversified in terms of I'm going to invest in tech companies, retail companies, pharmaceutical companies, etc. So for example, one of the things we saw overseas especially are the companies like Moderna, like Pfizer. Those are companies that got a lot of attention because of focus on vaccines. So depending on the industry you choose to be invested in, you could choose to be diversified across sectors, or you can actually be concentrated into a particular sector. And we'll talk about concentration next. Right. So this is just an example of what I was saying in terms of diversification. It's really up to you. One of the strategies I actually tweeted it out this morning is that my personal investment strategy is to start with one asset class. So let's say that I start with stocks. As I make money, as my capital grows, then I may then go to a unit trust. As this grows, as my capital grows, I may then go to bonds. So as I make money in one asset class, I'm spreading out that risk. As I said, I'm going into different asset classes, and that gives me some amount of protection from the different levels of risk. And it ensures that if any one vehicle goes down, then I have some amount of protection. Now, again, it's a personal preference, and you do want to consult a financial advisor before you make those specific decisions. The next thing that I want to talk about is concentration. Now, concentration can be within the asset class, as I said, or it can be within different classes. But let's say that we're talking about just stocks. Concentration may be considered you in being invested in only 5 to 10 stocks. All right. So that would be, so on our market, I think we have maybe about 100 companies. If you choose to invest in 5 to 10, what you're saying is that you're being invested in only 10% of the market. That's very, very concentrated. Now, some persons may say, well, let me invest in 20 or 30 companies. The challenge with this scenario is that you really want to know that you're competent and capable to pick the right ones, because a lot of persons don't have success in investing because they don't know how to select companies. So I'm going to share with you next how to go about short listing companies and then picking the right ones that match your investment goals, right? But the concept of concentration will come with higher risk, but of course, with higher risk comes a higher potential reward. And this is what concentration may look like. Now, as I said, it can be based on just a few asset classes, or I could be concentrated in terms of stocks only. So risk and reward is something that we're constantly thinking about as investors. There's no way to run away from it. It's something that we have to face. There is great reward for those who have the diligence to study, for those who find the right sources of advice and feedback, and for those who find the right asset classes, right? So don't be afraid of risk. All right, so I'm going to talk about how to pick your own stocks. Now, I've simplified the process because, I mean, we're trying to get this all done within a few minutes. But this is a topic that I've expanded on a great deal on our LearnGrowInvest YouTube channel, so you can see more content relating to what I'm going to share here. But the idea is that I'm going to take you through our process. Well, first, I'm gonna assume that there may be some persons who know nothing at all about stocks. I'm going to talk about, you know, what is a stock and the benefits of owning stocks. Then I'm going to talk about some of the considerations in selecting stocks, and then go through the process of picking your own, right? And then we'll take some questions after that. All right, so a stock, the best way that I can think of to explain it is buy a pizza, right? Because who doesn't like pizza? So it's considered fractional ownership of a company. So when you own a stock, you're owning a piece of a company. So if you bought Barita, for example, you're a shareholder, you own a piece of Barita. We spoke about Carib Cement as well. If you own shares in Carib Cement, you own a piece of that company. You're entitled to profits from that company. So the reason why companies issue stock is really to raise capital, right? There are many different reasons that may fall below that, but ultimately you're issuing more shares to raise capital to be able to whether undertake projects, clear expenses, or do a number of other things. So stocks are bought and sold on stock exchanges. So we have the Jamaica Stock Exchange, New York Stock Exchange, Trinidad and Tobago Stock Exchange, etc. And I mean, that's just there to make it easier for us, right? So historically, stocks are known to be the best performing asset class. And I'm hearing some members of my community say to me that I have to highlight the word historical because, you know, just because it was that way in the past doesn't mean it'll be that way in the future. Many debates have gone on about this. A lot of persons think, you know, cryptocurrencies are going to be the best performing asset class over the next 10 to 20 years. Time will tell, right? But stocks is still the number one go-to for most people. And I mean, that's why I figure most persons are interested in it still. So one of the very simple ways that I'll explain how stock prices move is supply and demand. Now, this is actually an interesting thing because there are a lot of ways to explain why stock prices move, and there are actually some persons who don't quite subscribe to supply and demand. So there are other things, right? And we'll talk about that soon. So why should you own a stock? As I said, you'll own a piece of a company, which makes sense that you'd want to choose a company as well, right? You don't just want to buy a stock for buying its sake. You don't want to buy it because Malik said to buy it or Jason said to buy it. You want to buy it because you have researched it, you've validated that it meets your goals and preferences, and you think that it's going to be a solid company to hold long term. One of the benefits you have is that you have the ability to vote at annual general meetings. So there are typically, you know, different things to vote on, and shareholders have the ability to vote. I believe one share is one vote or something to that effect. You also have the right to receive dividends. Now, not all companies pay dividends, but if they have a dividend policy, and I think you shared where Carib Cement is considering that, and so let's say that they decide that they're going to pay 70% of their profits or retained earnings in dividends. What that would mean is that from that amount that they agree, they look at the number of shares outstanding, and then if it is they have $80 in retained earnings, and we have 8 shares, 8 slices of pizza, then each shareholder would get $10, right? $80 available, 8 shares outstanding, then we have $10 per shareholder. So that's why if you do get dividends, you may see that, for example, your amount of dividend is small. That's really only based on the number of shares that you hold. So if you want those dividend checks to be higher, then you simply just need to own more shares. And then a great benefit is price appreciation, but also you should know that the price can depreciate as well. In terms of things to consider when selecting stocks, a lot of persons are driven by dividends, and I just explained that concept, so I won't go into it again. But remember, I shared earlier that one of my goals for investing is income generation. So I have a portion of my portfolio that's dedicated to dividends. So I research those companies. I look at what's called the dividend yield. And from that, I'll take a position in the company with the expectation that based on their dividend policy and their history of paying consistent dividends, and I can look forward to that dividend payment over each quarter or each year. Then the next thing that I'm looking at is what's called a price to earnings ratio. And what this is, we're comparing the market price of the stock relative to its earnings, right? So earnings per share is explained below, and it speaks to the profitability of the company. So if you've ever gone through an annual report, you'll see under the income statement, I believe, something called EPS, and that's showing you, based on the number of shares available, how much revenue or how much is earned per share, right? And so price to earnings is a metric that's used to compare companies within the same industry. It's used to compare a company to itself. So, you know, its PE might have been 10 now, but it was 5 before. It might have been 30 before, which might be considered overvalued. So, for example, in our market, I believe what's considered benchmark PE could be 20, and that's 20 times. So, so let's say that you may hear that a company is overvalued. I think a classic case is Jmmb. So Jmmb has been undervalued for a long time. I think it's trading at a PE of about 10, whereas other financial institutions may be trading at 20, 25, 30, etc. So relative to other companies in the same industry, Jmmb in that case would be considered undervalued. And the goal behind knowing this is that you want to invest in undervalued companies. Now, it's not as simple as saying, let me just find a company with a low PE, because a stock price doesn't move just based on that, right? But it's a good identifier in terms of companies to shortlist, because you do want to find companies that are undervalued. Because if we go to our very first definition of investing, our expectation is income or profit, right? So we want to find the things that are undervalued or that will grow in value later on that we can invest in. The next thing that we want to do to identify stocks to investing is we want to get comfortable reading annual reports. Now, it's not scary. It's just words and numbers, right? It's actually made very simple for us to understand once we can get past certain terms and understand the language of the company. All right, so annual reports are, if you're invested in a company, you should be looking at their quarterly and annual reports. And this is the source of seeing the company's financial performance and the health of the company. So you can take the financial statements, apply financial ratios, and use those ratios to assess things like liquidity, solvency, profitability, etc. Next thing that you want to do is look at analyst reports. So each brokerage firm will release a stock analysis every few months, right? They all do it, and the benefit of reading those reports is that you get to see what their perspective is on the company. They'll speak about their outlook. They'll speak about, you know, what the past performance has been. They'll speak about what opportunities they see and what risk they see as well. Now, this is something that you should take into consideration, but just like with everything else, you don't use one piece of information to determine an investment decision. You're going to consider multiple things, and in using all of the information that you can find, you make the best decision, right? The next thing that you want to do is follow the news. You guys are doing that very well already. Social media, and I wanted to put an asterisk there because social media is important to understand what's happening, but social media can be a source of what I like to call noise. So you want to, you know, filter the noise. Other sources of information you want to be following, for example, the Jamaica Stock Exchange website. You want to see the news and info coming out about the different companies. And there's actually, as I said, an in-depth video that we've done on this way to see what that process is. And Well, yeah. So after this, some other things that you want to think about are what we call some of the qualitative things about the company. What's its market share? What's the sentiment about the company? You know, what's the management like? So there are two terms called quantitative and qualitative analysis. So the quantitative speaks to things that you can measure. So that's from the annual reports. Qualitative are things that are more subjective. So like, as I said, that sentiment aspect is qualitative. So we can interact with a company and we get two different experiences, two different perspectives. So a lot of the times, for example, on the market where we may say a company that has a very high PE, so it's considered overvalued, but the sentiment is strong. Investors are bullish on that company. So they're willing to pay a premium, at least in the short term, for that company because they strongly believe in the company. Whereas we may see some companies that are considered undervalued or fairly valued, and yet investors aren't really that strong in terms of sentiment. So both sides are important, the financial performance and health, but also the qualitative side as well. All right. So that's actually it for my presentation. I think I'll take some questions now. Oh. Are there any questions? Let me actually check the chat now.
Hold on, Jermaine. I think there were some questions earlier. Yeah. Yeah, so guys, you can post your questions in the chat. I think there were some here.
Guys, you can also unmute and just speak.
All right, go again. So do I just go ahead and comment on some of the things that I'm seeing in the chat?
Yeah, of course. You can
Yeah,
go
sure,
ahead.
you can.
Yeah, sure.
Okay. All right. So I'm seeing a comment from Jason about not wanting to lose 2 million. And what I was speaking about there in terms of risk capacity, if I have 2 million, I may be willing and able to risk 1 million or 1.5 million and still hold on to the rest. So that capacity for risk, meaning that I have an opportunity to grow my capital at a rate that maybe somebody with less money couldn't. So that's really what that was about. But yeah, I agree. Most persons may be thinking of, I know persons with $2 million saved and they're not willing to risk more than 100,000, right? So it really, as I said, that willingness for risk is very important. Being alive is a risk. I agree with that, actually. So is there a course to understand the basic concepts? So as I said, our YouTube channel is there. I believe you guys cover a lot of that content as well. So I'd encourage persons to probably attend, all of these meetings. As the guy said, follow the community on social media as well. Investopedia is a very good resource. Jason, it's actually one of my go-to resources as well. So that's very helpful. CFI is very good. So CFI has some free courses and their YouTube channel is very good as well. So CFI has a course to understand financial statements, to understand accounting. So I'd recommend that course to anyone who wants to understand financial statements. And yeah, thanks, Matthew, for sharing the link to our channel. And okay, so Jmmb, I'll try and find the link for the Jmmb analyst report, but I would just search for Jmmb equity analysis and you're likely to find it. But they publish really good reports. I like Barita's report, VMIL reports, Sagicor reports. So those are some good ones that I know about. Oh yeah, see the link right there. Yeah, didn't see that. What do you think about Cygnus Group? As I said, I mean, Cygnus, well, we actually did a review on Cygnus on our YouTube channel. I like the company. I think they're good in terms of their approach. I mean, I think they've shown that their ability to consistently deliver. So yeah, I like the company. I don't follow Proven a lot. Actually, took a brief position in Proven last year, but I exited shortly after. It was no longer within my preference for a company, so I can't speak to it. So in terms of what portion of your disposable income would you recommend to be invested by Justin? That's something that you definitely want to consider all the variables that I mentioned. It really depends on where you are, how consistent that income is, how much you have saved, what you forecast your needs for cash will be in the future. But I would say invest as much as you can, right? So if it is that you for example, have low expenses, then you want to invest as aggressively as you can while you can. And whatever amount you set, just try to be consistent, try to automate, but you want to invest funds that you can actually allow to stay in the market for an extended period, you know, because there's a fee to buy and there's a fee to sell. So if you invest and then next month you need the money and you haven't gotten to your goal, then you're likely going to be selling at a loss, right? So bear that in mind. In terms of Janil's question, which investment vehicles do I recommend for aggressive investors? Well, stocks would be one of them. Cryptocurrencies would be one of them. But with both, you need to understand how the market works, how investors think, and you have to be very comfortable with risk and volatility, right? So there are many. So just because I said stocks doesn't mean that you should buy any stock. So you want to research it well. But for an aggressive investor, you're looking at growth stocks, and so that's where I'd start. In 2022, JSE will introduce short selling. How do I think this will affect the markets? Well, so for those who understand the concept of short selling, I mean, I'm curious to see how it will impact it, but I think it would give a lot of investors opportunities for profits based on their ability to determine when a stock may face correction. It really comes back to you know, even though the market operates now, there are many who don't understand it. I think for those who already don't understand it, they may not understand shorting, but it's not something that you have to take advantage of if you don't understand it. But I think you'll provide opportunities for those who are able to take advantage of it. Would I recommend it? Only if you understand it. So it's a personal decision. Like for example, I invest in the US market, but I don't do shorting for US stocks, and it's just a personal preference. But so the idea of shorting is that you make money when a stock goes in the opposite direction, right? So when it goes down, you have the ability to make money. So it's like saying you're going to take out those shares from your broker at $10, and you may be betting on them going to $5. When it gets to $5, you pay your brokers, you pay your broker for the shares at $5, and that remainder is your profit. So Jada is asking, what are blue chip stocks? A blue chip stock is considered, think of companies like NCB, like Seprod, companies that have been around probably before you were born and will be around, you know, after we're no longer here. So they're consistent, their performance is consistent, and I mean they're not going to grow aggressively, but they're going to likely pay consistent dividends and their performance quarter after quarter will be what you can expect. So blue chip is considered stable. It's considered a great source for dividends. And it's for that investor who wants to know and be confident that the company is not going to experience great volatility. Now, we see with a lot of the blue chip companies from COVID that they haven't been performing as well. And that just speaks to the nature of the market and how it is now. But we're not worried that NCB won't be here after the pandemic. We're not worried that Wisynco won't be here. We're not worried that Separate won't be here. So it really, that's kind of what you think about when you talk about a blue chip company. I think I've answered all the questions.
I think there's one last one. What are fixed income stocks?
Okay, so fixed income, I mean, think about the term. So a general rule of thumb, when you think about an investment term, usually it's self-explanatory. So fixed income means your income is fixed, right? So think of the bond, for example, it has a set amount that it will pay you. It's for a set period, and it's considered low risk, though you should know that it means there is still some risk, right? We've seen stories of bondholders for certain companies not being able to get their money, but fixed income is typically a vehicle that you go to for more reliable streams of income, right? So hopefully that helps. Sebastian is asking, would I say that investing in stock takes more fundamental analysis than technical? No, right? It's not just any one thing. It takes understanding of both. Do I use one more than the other? Personally, I use fundamental analysis more, but I mean, it really depends, right? So both skills are worth it to learn. And the more you understand how the market works, how investing works, then you'll begin to work out a system of how to use these things, right? So again, some of the things I would have shared in terms of that fundamental analysis process are some of the things that I use. Do I use all of them all the time? No, it depends on my existing knowledge of the company. And there's some things that really, in terms of short term, may just come down to sentiment, and fundamental analysis means nothing, right? There's a question about preference shares. So a preference share, so a stock is also called a share. A preference share is, again, think about what the word is saying, preference. So that shareholder or those shares have preference. So you may get, for example, let me actually bring up something that will help me explain it so I don't misguide you, but preference shareholders would typically be higher in terms of ordinary share. On that ladder, in terms of preference for repayment if the company is liquidated, preference shareholders would get that. In terms of they're traded just as regular stocks. So on the market, you may say a Jmmb 7.5% preference share. And that would just mean that for example, you're getting 7.5% interest, for example, on the amount that you have invested. Based on the fact that it is traded though, that is something that a lot of persons I find may not understand fully how they work. But yeah, as I said, I'm going to bring up something very soon to kind of explain, because I actually covered it a few weeks ago. So I'll bring that up soon. Is it possible to directly reinvest your dividends back into new stocks? Justin is asking that. Well, in Jamaica, I can't think of any, but in the US, you can do that. You can have your dividends reinvested automatically. It's actually something that I prefer, because I want to keep my money in the same stock so that my units grow and so that my future dividends increase. So in Jamaica, you'll have to manually make that purchase yourself. But in the US, it is something that can be done. Victoria kind of commented on it. Omar is asking if I could recommend a company to invest in, what company would it be? I guess Omar wasn't here at the start. Omar, I can't answer that question. What I can say is that if you're looking for companies to invest in for yourself, start with industries you understand, start with companies you understand, and assess them based on the industry, the economic environment, and those are good places to start. Yeah, so Matthew is saying a dividend mandate. So what a dividend mandate does, it's instead of you getting the check, it's those dividends are added as cash to your account. Once it's on your account, you can just place an order for that same stock using the amount of money that you have. Now, for example, depending on the size of that dividend, you may not be able to buy one whole share, and we don't have fractional shares available locally. But what I do is that I put the funds on the account using the dividend mandate. When it gets to a certain amount, like 10,000, 20,000, then I may just buy shares of that same stock. Because as I said, as I get more and more dividends for that stock, my position in the company grows without me having to invest more of my own capital. So reinvesting your dividends is actually something I'm a great advocate for. All right, so let me try and find that information on preference share as I promised. All right, so the notes I'm finding here is that the holders of preference shares will have certain rights and privilege over ordinary shareholders. I would have said that before. So there are different classes of preferred shares, which will have different levels of rights. The most common types give the preference shareholder a right to receive dividends at a fixed rate. So that's what I was saying before. So for example, if you see that, let's say that Jmmb 7.5% preference share, then that percentage you're receiving in dividends based on the amount that you would have invested. And the right of payment in case that company goes bankrupt, you get you're higher on that ladder as opposed to that ordinary shareholder. I mean, it fits a certain type of investor, and there are opportunities you'll see in the market that you may be able to trade some of them, but it's not something that I have a lot of personal experience in. I mean, it just doesn't fit what I'm interested in, but hopefully that information helps. And yeah, I'm sure it's a topic that we'll cover at some point on our channel as well.
Okay. Yeah, guys, thank you for coming out so much. And Jermaine, thank you so much. You brought so much value. Thank you for talking on finding the right investment force and everything. You talked about like the basics up into the moderate kind of stuff. So thank you so much. You did so well. Everyone is happy here. And yeah, we look forward to having you again, maybe sometime in the future. Thank you for coming out, guys.
Thank you.
Yeah, that was a great presentation. Thank you for coming out.
Very good.
And I wanted to ask, is it possible for us to get those slides? Because they were really good and I'm sure our members would love to have them.
Let me get back to you on that.
Okay.
Yeah, because so this presentation is something that we build on all the time. We actually use it in our free investment class. But let me see what I can do for you. Let me see what I can do.
I guess we can just communicate with Malik and see. All right. Thank you so much.
I will.
Thank you so much, Jermaine, and thank you everyone for coming out to today's meeting. It was truly informative and we learned so much from you. So thank you guys for coming, and make sure you sign up for the stock market game that we have officially collaborated with the Jamaica Stock Exchange for. It's an incredible opportunity, guys. This is the time to get your practice before you invest with your real money on the stock market. So you're investing with virtual money and testing it out to see. So this is the time to make your mistakes and learn from them so that when you actually invest your real money, you can make those gains and make great decisions. So thank you so much again to everyone. Stay tuned. As you can see, we've been having really informative meetings. So stay tuned for what's coming next week and the week after that. So thank you all and stay safe.
Yeah, guys, I just dropped the link again in the chat to sign up for the stock market game. So don't wait, sign up right now. You do not want to put it off. It's going to start next week, Monday. So yeah, and I'll also drop the video explaining how it will work in all the group chats after this meeting. So have a good day and stay safe, guys.
Oh, and just for the record, guys, it's free to sign up for the stock market game. It's 100% free. You actually get 100,000 virtual money. And as Malik mentioned, we may give out prizes. So you want to get in, do your research, and do your best so you can make your portfolio grow. So sign up. The link is in the chat and look out for it. All right. Thanks, guys. Take care.
All right, guys. See you guys next week.